Managing the Taxes on Your Retirement Income, presented by Doug Ewing. He is Vice President of the Insights and Solutions Field Team at the Nationwide Retirement Institute. As a reminder, this session is being recorded and will be made available on the events page of our website once approved. This webinar is hosted by Lumina Financial Strategies, and your moderator today is Allison Fleming, President of Lumina Financial Strategies. Allison is a certified financial planner practitioner, and for those of you who may be joining us for the first time, I'll go ahead and introduce her. Allison's been a financial advisor since 1989 and serves clients in 29 states across the country. She holds a bachelor's degree in speech communication from Cal State Long Beach and believes that we must always adapt to the changing environment, remain current, and take advantage of opportunities to improve our clients' lives. Our local motto, "Be a long-term thinker, not a short-term worrier," serves as the cornerstone of her discussions. With that, I'll hand it over to your host, Allison.
Hi there, everybody. Thank you so much for attending our webinar this afternoon. We have a large group today, which I'm really happy to see. I know that our guest speaker, Doug, has presented for us, I think 4 times or maybe even 5 times. I'm not quite sure. He was one of our first presenters when we first started doing webinars. And so before I introduce you to Doug, let me go ahead and make sure that you know who we are for those of you who may be new to our team. This is our team. We have Miles Fleming, who's Executive Vice President, Insurance Specialist, and he specifically works with Medicare. So if you know anybody or you yourself are coming up on 65, he is the person to talk to about working all of that stuff out. We have Britt Stevens, who's our Vice President and my partner in many meetings. We have Peter Fink, who's our resident stock picker, and Damian Feldman, who's our Client Experience Manager. He's the person that you probably talk to at the front desk and who is the keeper of the calendar at all times. We have Terry Jocelyn, who's our executive assistant and administrative manager, keeping things in the files and the meeting prep all organized and tidy. We have Maddie Uoa, who is up in our San Pedro location as an administrative assistant, recently got her insurance license, which is great. We have Kaylee Levin, who is our client care coordinator here in the San Diego office. She often attends the meetings with me, so many of you have met her as well. We have Lucy Adame, who's an administrative assistant, also located in our San Pedro office. She's been with us for many years as a part-time person going to college and graduated, decided to stay with us, so we are grateful. And then finally, we have Chris Vera, who's our creative director, the voice from the sky, the mistress of the webinars, and all things branding, marketing, and creative. So with that in mind, now that you've met our team, there's our disclosures. We're licensed all over the place. And now you've been fully disclosed. So with that, I would love to invite our friend Doug Ewing to join us here from Nationwide on camera. Hi, Doug.
Hey, hi,
It's been
Allison.
at least like a year since I saw you, right?
I think so.
The last webinar anyway. Yeah, so Doug has done a number of our webinars. Basically, he's come back every year, which we are so grateful for because everything is changing every year about Social Security and taxability and all the things having to do with that. So Doug is well educated. He presents this stuff all over the country. And we're just grateful that you're here to talk to our clients because there is a lot going on right now.
Absolutely.
So I'm just going to turn it over to you and let you take it away.
All right. Well, thank you very much, Allison. Thanks, everybody, for joining us. Again, as Allison mentioned, my name is Doug Ewing. I'm with the Nationwide Retirement Institute. I'm sure you recognize the logo. We all know the jingle, which is good because I don't like singing it. But I am excited because today we're going to be sharing what is one of my very favorite topics. We're going to be looking at strategies to help you manage the taxes on your retirement income. So we've got a lot to cover here today, and we are going to dive right in. Now, of course, the first thing we have to do here is, let me see, carefully review our important disclaimer slide. And so as you guys are carefully reading this slide, I'll tell you a little bit about myself. I cover the western part of the country for the Nationwide Retirement Institute. I am an attorney by background, and like Allison, I also hold a certified financial planner designation. But it is important for me to point out that while our topic today is taxes, I am not here today to provide tax or legal advice. And I recognize that Allison and her team don't necessarily give tax or legal advice either. My goal today is to provide an educational overview of how taxes work in retirement so that you can make good decisions not only in retirement, but also as you prepare for retirement. Now, one other thing I'll mention before we get started is questions. We are going to hold Q&A until the end of the presentation. And so as I'm delivering the presentation, I don't see the hands going up or down. So if you do raise a hand and I don't respond right away, please understand I'm not being rude. I just don't see it, and we're going to hold those until the end. But I am looking forward to answering your questions, and we will definitely set aside some time for that at the end. So let's get started. We'll take a look at today's agenda. So, what we're going to do today is start by reviewing what we would consider to be tax basics. And specifically here, there are a couple of different types of taxes that you want to be familiar with as you approach retirement, and we will cover those. As we make our way through the presentation, you are going to pick up on a pretty obvious theme, and that theme is the importance of having diverse sources of retirement income. Now, that term diversification, I'm sure you've heard that before in the context of how we invest for retirement, right? And that's because diversification is a risk management technique, right? When it comes to the markets, we don't know at the beginning of any given year what the markets are going to do. We don't know which investments will do well. We don't know which investments might lag behind. So what we do is we diversify. We put our money in different types of investments: large company stocks, small company stocks, international stocks, fixed income. And the reason we do that is to sort of smooth out our returns and manage our risk. Well, when it comes to taxes, it's a very similar type of concept. We don't know what the future holds with respect to tax rates. We don't know if they're going to go up. We don't know if they could come down. So what we can do, and taxes, just like market returns, are a potential risk to our retirement savings. So if we can diversify across different types of accounts in which we can save for retirement, what that will do is it will give us the flexibility later on to manage our tax bill in retirement. That's really the goal. So, and then we'll talk about some next steps, including some really cool stuff that Allison and I were talking about before we got started. So we will share that with you as well. So we'll start by reviewing what we refer to as tax basics. And basically what we're looking at here are two types of taxes that we want to be familiar with as we both save for retirement and then as we transition into retirement. Now, the first one you are going to run into every single year from now until forever, and that is ordinary income tax. Now, the second type of tax we'll talk about, capital gains, that's something you may only run into occasionally as you save for retirement and transition into retirement. But it is still important to understand how capital gains are taxed, because in certain situations, capital gains can provide you with preferential tax treatment. So let's start, though, with ordinary income. And I think the easiest way to understand what we're talking about when we use that term ordinary income is to think about our wages from employment. Right? We've all been working throughout our adult lives. We all kind of know the drill by now. We work all year, and then December 31st comes along. And what happens after December 31st? We start getting tax forms. So if we are working, we might get a W-2, which is what we would get if we're an employee. If we're an independent contractor, we might get a 1099. But either way, those forms basically do the same thing. They tell us and they tell the Internal Revenue Service how much money we made for the year. And then what we do is we take those forms and we prepare a tax return. We report all of our income to the IRS. We take whatever deductions we are entitled to, and that's very important. And that gives us something called our taxable income. And we'll look at how that income gets taxed in just a little bit. But But I like to start there because, a lot of the income that we will receive in retirement is basically going to be taxed just like our taxes from work. And the first type of income I'll talk about, it's not on the slide, but I'll mention it really quickly, is pension income. If you are one of those fortunate people out there who will receive a pension in retirement, and unfortunately that number keeps coming down every year, that pension income is considered ordinary income. Now, the next type of income I'll talk about is income from certain retirement accounts. And specifically, what I'm talking about here are tax-deferred retirement accounts. These are by far and away the most popular way that people save for retirement. And I'll just review really quickly how a tax-deferred retirement account works and some things that you want to think about if you have money in a tax-deferred retirement account. So we get paid every pay period. And in a tax-deferred retirement account, we are going to take a portion of our paycheck and we are going to defer that on a pre-tax basis into a retirement account. So that money is not being taxed now. It goes into our tax-deferred retirement account. Once it's in there, we invest it. That money begins to grow over time. That growth is tax deferred. So we don't have to worry about paying taxes on the growth as we are making our way through our working years. So whenever you have money in a tax deferred retirement account, I think it's really important to remember a couple of things. First of all, that money has never been taxed. And so the goal with any tax deferred retirement account should always be, how do I get that money out of that account at the lowest possible tax rate? And, tax deferral is a great way to save for retirement because ideally what we're doing is we are avoiding paying taxes on that money during our working years when presumably we're going to be in a higher tax bracket. And we are shifting that tax liability into retirement when in most cases we're going to be in a lower tax bracket. So tax deferral works really well. But here's one thing to keep in mind. It doesn't last forever. Eventually, we will get to a point where we have to start pulling money out of our tax-deferred retirement accounts. These are called required minimum distributions. And here's what's interesting about required minimum distributions. Over the last 5 to 10 years, Congress keeps changing the rules on required minimum distributions. It used to be that we would take our first required minimum distribution in the year that we turned 70 and a half years old. Then a few years ago, they pushed that back to 72. And then even more recently, they pushed it back to 73. And for many of us, we will not have to take our first required minimum distribution until we turn 75 years old. And here's the issue with that. When people hear that Congress keeps pushing back that first RMD, a lot of people react to that by thinking, aha, that must be a good thing, right? Maybe I should wait to take money out of my tax-deferred retirement accounts as long as I can. I have other money available, so I'll just wait to take money out of my tax-deferred retirement accounts. And here's the thing, that could be a mistake. And the reason I say that is, as we're going to see today, you may have opportunities much earlier in retirement to pull money out of your tax-deferred retirement accounts, not because you have to, but because as of this year, we are in a very favorable tax environment. And if you can get money out of your tax-deferred retirement accounts sooner rather than later, and you can do it at a low tax rate, that's something that you might want to think about. Now, we'll expound on that idea as we go through the presentation. Now, another way that some people will save for retirement is through a good old-fashioned savings account at the bank, or you might have money in a money market fund or even a certificate of deposit. Well, one thing to be aware of with that type of savings is that the interest you make on that money is typically taxed as ordinary income. So, until recently, if I were talking to you 5 years ago, that would not have been a very big deal because it wasn't that long ago that banks weren't paying a lot on savings. You weren't making much interest. Well, now interest rates have come back up. Some people are finally starting to make a little bit of interest on their savings. Well, keep in mind, you do have to pay taxes on that money, typically in the year that you receive it. So we'll talk a little bit more about that. But the thing about something as simple as a savings account can be very helpful later in retirement to help you manage your tax bill. We'll see an example of that toward the end of the presentation. And then finally, there's Social Security. I think I may have talked to you guys about Social Security in the past, and the big issue with Social Security is when do you claim your benefit? You can claim it as early as age 62. You can wait all the way until 70. As a general rule, the longer you wait to claim your Social Security, the bigger your check is going to be. And what's cool is you don't have to pay taxes on all of your Social Security. We will cover that later as well. But to the extent you do, that's going to count as ordinary income. So as you can see, that's why I say, you're going to have ordinary income pretty much every year for the rest of your life because of those types of income that we just went through. But now let's talk about capital gains, because capital gains work a little bit differently. First of all, a capital gain is different than income. And the easiest, simplest definition I can give you of a capital gain is it's very simply a profit that we make on an investment. And there are two areas where people will typically run into a capital gains situation. The first is if I am investing outside of a retirement account. And I'll give you an example of that in just a second. And the second is real estate. So let's talk about investing outside of a retirement account. What do I mean by that? Well, let's say that I have some savings and I'm looking at this money and I'm thinking, I don't need that money for a long time. I'd like to try to grow that money. I'd like to invest it. Well, what I can do is I can open up something called a non-qualified brokerage account. Allison and her team would be happy to help you set up a non-qualified brokerage account. And because it's not a retirement account, you can put as much money into that account as you want. And then once it's in there, you can invest in pretty much anything you can think of: stocks, bonds, ETFs, mutual funds, whatever. So let's say I do that and I open up a little investment account and I'm sitting there and I'm thinking, what am I going to invest in? And I look down and I see, aha, here's my iPhone. Apple, right? As we know, Apple is one of the most valuable companies in the world. I've always been a big Apple fan, so I decide, geez, I'd like to buy a little Apple stock. So I look up Apple and it's trading at $100 a share. So I buy a few shares of Apple stock. A couple of years go by. I look down at my iPhone and I say, why, look at that. Apple's up to $120 a share. So I decide to sell it. Well, that $20 a share that I made on that Apple stock, that is a capital gain. And I will have to pay taxes on that in the year that I sell that Apple stock. Now, here's the thing. A lot of people don't invest much outside of their retirement accounts. But there is one investment that many of us will make during our lifetime that can also generate a capital gain, and that's real estate. But when we think about real estate, there are two, I'm going to basically break it down into two very broad categories. The first is called our primary residence. That is IRS lingo for the house that we actually live in. And then there's pretty much everything else. And I'm actually going to start with an example of everything else. So I don't know about you guys, but in my house, we watch a fair amount of HGTV. And if you ever watch HGTV, you know that one of their favorite things to do on HGTV is flip houses, right? There's probably about 20 shows on HGTV where they flip houses. And that's a great example of a capital gains situation. So let's say that I've got some extra money and because I watch so much HGTV, I decide, well, rather than invest in stocks, I'm going to go and I'm going to invest in real estate. So I find a little fixer-upper. And let's say I find that little house for, I don't know, we'll say $400,000. And it's in rough shape. So I spend another $100,000 fixing it up. So I've now invested $500,000 in that house, but I did a really good job. It looks beautiful. And because of that, now I'm able to put it on the market and I can sell that house for $600,000. So I invested a $500,000, selling it for $600,000. I just made a $100,000 capital gain. And again, I will have to pay taxes on that gain when I sell the house. But here's what's really important to know because the rules are a little bit different when it comes to your primary residence. And the reason I always like to mention this is, let's face it, when we're getting ready to retire, in a lot of cases, we might sell our house, right? Maybe the kids are gone and it's time to downsize, or maybe you guys live in California, so you probably don't ever feel like you need to relocate, but maybe I decide, I'm going to relocate, so I'm going to sell my house. Well, when you sell your primary residence, and there is a technical definition of primary residence, but we're just going to go with the house that you actually live in. You get a break on capital gains taxes. You can actually see it's at the bottom of the slide in the fine print there. If you're a married couple filing a joint return, you can exempt up to $500,000 of capital gains when you sell your house. If you're a single person, it's $250,000. And so again, quick example, my wife and I, let's say we bought our house 20 years ago for $500,000, and now we're able to sell it. And let's say we get $900,000. Well, that's a $400,000 capital gain. But if I can exempt 500, that completely wipes out that gain. I'm going to get that 400,000 completely tax free. But of course, if I sold the house for 1.1 million, and that's a $600,000 gain. I could only exempt 500. I would have to now pay capital gains on that extra 100,000. So please understand, these are very simplified examples. And if you have a piece of property and you're thinking about selling it and you need information about a capital gains situation, you are absolutely going to want to sit down with a qualified tax professional. And in fact, just going back to my original disclaimer, whenever you need personal tax advice, that's where you're going to go. You're going to have to sit down with a tax professional. So just to be very clear about that. All right. So what I want to do now is get into how ordinary income is actually taxed. And this brings us to a discussion of tax brackets. We've all heard that term before, tax brackets. Well, now we're going to see exactly how tax brackets work. And think of it this way. Every year, January 1st, right, we have made zero money for the year. And as we make our way through the year, hopefully we're going to make money. We're either going to get paychecks or, we're going to have profits from our business. And during the course of the year, we're just going to start building a pile of money. Well, what you want to remember is as we build that pile of money, each layer of that pile is going to have a different tax rate. And again, remember what we do is at the end of the year, we report all of our income and we take our deductions and then we apply the tax brackets. So let me talk about deductions for a minute because this is very important. We got a very consequential piece of tax legislation last summer. It was called the One Big Beautiful Bill Act. And what that act did was a couple of things. First of all, it made the standard deduction system that was first introduced in the Tax Cuts and Jobs Act back in 2017, made it permanent. And that's a big deal because the Tax Cuts and Jobs Act was scheduled to expire at the end of 2025. If that had happened, long story short, it would have meant a substantial tax increase for just about everybody. So the One Big Beautiful Bill Act sort of stabilized and gave us some permanence on taxes. And what it also did was it slightly increased the standard deduction that we are all entitled to. So when you report all of your income, then you take your deductions. Now you have two options. Option number one is you can itemize your deductions. Now, the One Big Beautiful Bill Act did do something on itemized deductions that is definitely worth mentioning. Under the Tax Cuts and Jobs Act, the deduction that you could take for state and local taxes was limited to $10,000. Well, under the One Big Beautiful Bill Act, that deduction limit has been increased to $40,000. That it does get phased out once your income hits about $505,000. That does start to get phased out, but that can be, if you have if I'll give you a kind of a quick scenario of somebody who might be inclined to itemize. If you have a large home and you have significant mortgage interest, and because mortgage interest is deductible still, and you have significant state and local taxes, um, and maybe you're making big charitable contributions, right? If your itemized deductions add up to more than your standard deduction, you can take your itemized deductions. You are still allowed to do that. But what's interesting is that according to the IRS, since the passage of the Tax Cuts and Jobs Act, about 90% of taxpayers are simply taking the standard deduction when they file. I know personally, I take the standard deduction when I file my taxes. So it's a pretty generous standard deduction. So we all start with a standard deduction for 2026 of $16,100. If you happen to be a head of household, which is a single person with dependents, like say you're a single parent, you actually get a standard deduction of $24,150. But when you hit age 65, you get a nice little bump in your standard deduction. So if you're a single filer, you get an extra $2,050 added to your standard deduction. That would bring it up to the $18,150 that you see on the slide. And if you are a married couple filing a joint return, you each get an extra $1,650 added. One is each spouse hits 65, they get an extra $1,650. So if you're a married couple filing a joint return and you are both age 65, your standard deduction is now $35,500. That's pretty good. And you know what? It actually gets better. And that's because the One Big Beautiful Bill Act also introduced a temporary senior deduction. The reason I say it's temporary is it is only available, it was available in 2025. So some of you, when you do your taxes, you might get a little bit bigger refund than you think, or you might have to write a little bit smaller check to the IRS because you may qualify for that temporary senior deduction. So it was available in 2025. It's available in 26, 27, and 28, and then it is scheduled to expire. So that temporary senior deduction is a per person deduction of up to $6,000. It does phase out. So if you are a single filer and your income, your taxable income exceeds $75,000, it starts to phase out. If you are a married couple filing a joint return, once your income exceeds $150,000, it also starts to phase out. But, you know, if you can keep your income below those thresholds, looking at a married couple, for example, that means you could have a total deduction to start this year of $47,500. That means the first $47,500 of ordinary income that you have is essentially tax-free. So when we think of our first layer of income, if you think of that as your first layer of income for the year, it's basically a 0% tax bracket, which is really pretty good. Now, once we get above that level of income, now we start bumping into the brackets that you see on the slide. And as we make more money, we start at the lowest bracket, 10%. Then on our next layer of income, we pay 12. And then on our next layer of income, we pay 22 and so on. We'll see a good example of this on the next slide. So that's how the tax brackets work. Now, before we move on from this slide, I want to encourage you to do two things. First of all, I want to encourage you to figure out what your tax bracket is, right? All you have to do is think of, okay, how much total income am I going to have for the year? And then you back out whatever your available deduction is. We'll say, you know, if you're not 65 yet, it's going to be, we'll call it 16,000 just to keep the math nice and easy. So if I had $100,000 of income, I'm going to deduct 16,000. That means my taxable income is 84,000. If I'm a single filer, I look up 84,000. That would put me in the 22% bracket. That doesn't mean I pay 22% on all of my income. It just means I would pay 22% on my next dollar of income. If I'm married, you know, you look at you and your spouse together. Let's say we make, 24,000, or let's say we make 250,000 for the year. We have two standard deductions, so that's 32,000. That would put us at $228,000 of taxable income. I look up 228, that would put us in the 24% bracket. Always a good idea to know your tax bracket. Now, the one last thing we'll touch on before we move on to the next slide, look at the difference between married filing joint and single. What you will notice is that the brackets for married filing joint are twice as wide as the single filer brackets. That means you could have twice as much income before you bump up to the next bracket. And for people who are retired, this can be a really important opportunity. So if you go into retirement as a married couple, it's funny, I actually was at an event recently and I got to have a great conversation with a really good CPA who I saw present. And she basically confirmed what I've been saying for a long time, which is take advantage of that married filing joint tax status, right? That's a wonderful opportunity to potentially get money out of your tax-deferred retirement accounts at a lower tax rate than you would as a single filer. And the reason you want to take advantage of that while you're married is that what happens with married couples is eventually one spouse passes away. And then what happens is that surviving spouse, that widow, becomes a single filer. And that means only one standard deduction. It means you're using these single filer brackets, you're getting to higher tax rates at lower levels of income. And one thing I have seen personally is widows, especially once required minimum distributions have begun later in retirement, they get hit much harder on taxes than they were as a married couple because they've gone from married filing joint status to single filer status. So one potential advantage to getting money out of your tax deferred accounts while you've got that married filing joint status is you can reduce the amount in your tax deferred retirement accounts, which means smaller required minimum distributions. And when you're moving money out of your tax deferred retirement accounts, it's really important to understand. I'm not suggesting that you spend that money, but in many cases, what you can do is you can reinvest it. You can invest some of that money in a taxable account, or you can move some of that money into a Roth account. We'll talk more about Roth accounts a little bit later, but that is an opportunity. So something to think about. Okay, so this example I love because what we're going to do here is we're just going to show you exactly how income is taxed. And this is a great example of what I said a few minutes ago when I said our income is taxed in layers. So in this example, let's assume I'm a single guy. And so I'm a single filer. And I had a lot of income this year, $150,000 of gross or total income. I'm getting my Social Security. Maybe I have a small pension. I had some extra expenses, so I pulled more money out of my tax-deferred retirement accounts. That all adds up to $150,000. So how is my tax bill calculated? Well, first thing I'm going to do is I'm going to take my standard deduction of $18,150. But I'm also going to make sure I take my temporary senior deduction. Now, you may notice here, my temporary senior deduction is only $1,500. Wait a minute, I thought you said it was $6,000. The reason it's only $1,500 in this example is because I'm over the phase out. So the phase out starts at $75,000 and it runs, but I don't get completely phased out until I get to $175,000. So from 75 to 175, it's prorated. So at 150, I would get three quarters of my temporary deduction are going to get phased out, but I would still get that extra $1,500. So I add that to my $18,150, that gets me to $19,650. So that is my deduction. That is essentially my 0% bracket. And what that means is my taxable income at that point is now $130,350, right? It's just the 150 minus the 19,650. So once I know what my taxable income is, now I can apply the brackets. And this is what I mean when I say our income is taxed in layers. My first $12,400 of taxable income is only taxed at 10%. That adds $1,240 to my tax bill. Now, my next layer of income from $12,401 to $50,400, that gets taxed at 12%. That adds $4,560 to my tax bill. Now, I want to stop here just for a second, because if you notice, when I get to the end of the 12% bracket, what's the next bracket? 22%. It's a much higher tax bracket. And if I were to calculate my average tax rate at the end of the 12% bracket, I would have $70,500 of total income, and I've paid $5,800 in taxes. So if I were to average that out, that would come out to an average or effective tax rate of just over 8%, 8.2%. And here's what I would suggest. If I can pay federal income taxes on my retirement savings at 8.2%, that's not a bad deal. By historical standards, that's pretty good. And I might want to take advantage of that, even if I didn't necessarily need all that money, because that's a pretty compelling tax rate. But of course, in our example, what's the problem? I'm not done paying taxes yet. And what we see very clearly here is look at the impact that that 22% bracket has. My taxable income from $50,401 to $105,700, that gets taxed at 22%. That's going to add over $12,000 to my federal income tax bill. And then I bump into the 24% bracket, and I don't even get all the way through the 24% bracket. I only get about a third of the way through. But that still adds almost another $6,000 to my federal income tax bill. So look what happens. By the time I'm done, I owe over $23,000 in taxes, and my average or effective tax rate has now increased. It's basically doubled all the way up to 16%. So as you look at this example, I'm sure some of you are already thinking this, but it's like, wouldn't it be great if I could just take out enough income every year to use up my standard deduction, use up my temporary senior deduction, fill up that 10% bracket, fill up that 12% bracket, but avoid paying taxes at 22 or 24%. I think we'd all agree that would be great, right? Well, the question is, how do I do that? And the answer, I believe, is tax diversification. So if, as I am saving for retirement, I can be leveraging different types of savings accounts, different types of ways to save for retirement, I can get tax diversification, and that can help me manage my tax bill in retirement. So I often refer to this as having three different buckets of money: a taxable bucket, a tax deferred bucket, and a tax exempt bucket. So let's go through these three buckets, and we'll explain them in a little bit more detail. So when I use that term taxable bucket, all I'm implying is that these accounts do not enjoy tax deferral. So for example, if I open up that non-qualified brokerage account where I bought that Apple stock, right? Remember the Apple stock. I'm going to use that as an example a couple of times. So that's not a tax deferred account. If I sell my Apple stock, I will pay taxes on the gains in the year that I sell that stock. What if I have a savings account at the bank? Well, that savings account is paying me interest. When do I pay the taxes on that interest? In the year that I receive it. So they're just not tax deferred accounts. Now, the one thing about taxable accounts that you want to understand is that this is where you may be able to take advantage of capital gains tax treatment, specifically long-term capital gains. Because whenever we sell an investment, the first question we're going to ask is, how long did you own that investment? And the magic holding period is 1 year. If I own an investment for 1 year or less and I sell it, well, that's considered a short-term capital gain. And short-term capital gains do not give me any sort of tax advantage. They're actually considered as ordinary income, and I'm going to pay taxes at ordinary income tax rates on my short-term capital gain. But if I own an investment for more than a year and I sell it, well, now it becomes a long-term capital gain. And long-term capital gains get better tax treatment than ordinary income. So if you look at the bottom of the slide, you'll see that for long-term capital gains, there are only three tax brackets: 0%, 15%, and 20%. Now, before you get all fired up over that 0% tax bracket, please understand that when the IRS is calculating the tax on your long-term capital gain, they start with all of your other income first, and they then they plop your capital gains on top of it. So if you have other income, it's remember when you went to the ice cream truck and you got a what they call it, a push up, the ice cream in the tube, you push that up and all that, everything that goes above the threshold, your capital gains will be at the top of that. And your ordinary income will often push your capital gains to the point where you're paying at least 15%. But each one of these tax brackets is better than the corresponding tax rate on ordinary income. So I'll give you a quick example. So let's say I'm a retired guy, I'm 65 plus, and it's November, and I know because I'm a tax geek that I'm sitting at $50,000 of taxable income for the year. And at $50,000 of taxable income as a single filer, that would put me in the 22% bracket. But it's November. I need a little bit more money for the rest of the year. So now I'm figuring out, well, where should I get that money? Well, if I have a choice between pulling money out of my tax deferred retirement account and paying 22%, or looking at my non-qualified brokerage account where I have that Apple stock and maybe just selling that Apple stock instead, that might be a better opportunity. Why? Because, well, obviously 15% is better than 22%, but it's actually even better than that because when I sell my Apple stock, what am I actually paying taxes on? Just the gain. The $100 a share that I invested in the Apple stock, that's my cost basis. And I get that money, that's after tax dollars. I get that money back without any tax ramifications at all. So as you can see in that scenario, having the ability to tap a long-term capital gain instead of ordinary income, that's a way for me to keep my tax bill a little bit lower for the year. And that's why having taxable accounts can be very helpful as far as tax diversification goes. Now, the next bucket is our tax deferred bucket. And here's what I will tell you about the tax deferred bucket. I actually, as Allison does, I worked as a financial professional for a few years, and I worked with a lot of people. I'm going to go out on a limb and bet Allison backs me up on this, but most people have most of their retirement savings in tax deferred retirement accounts. It is a very popular way to save for retirement, as it should be, because it works really well. But tax deferred retirement accounts have been around the longest, and a lot of people just, that's automatically what they do. And so if we look at the average person going into retirement, their tax deferred bucket, their 401ks, their IRAs, for most, this is already the biggest bucket of money. So for when we talk about tax diversification, this isn't, we don't really have to focus on this because this is already people's biggest bucket. Where most people are lacking, in my experience, is in this last bucket. And this would be the tax exempt bucket. Now, as you can see on the slide, there's a lot of ways you can get tax-free income in retirement. If you invest in municipal bonds, you already know municipal bonds pay tax-free income. If you have permanent life insurance, the kind that has a cash value on the statement, you can oftentimes tap that, basically tax-free. Health savings accounts are another example. If you have a health savings account that you've accumulated during your working years and you're using that money to cover your qualified medical expenses, that comes out tax-free. But I think the biggest opportunity for most people to build up a tax-free bucket of money for retirement is to leverage Roth accounts. And Roth, when you hear that term Roth, it is just a different way to save for retirement. So under a Roth account, you're just making a different deal with Uncle Sam. Because in a Roth account, what you're doing is you're foregoing the tax break on the retirement plan contribution. So when you contribute to a Roth account, that money you are not avoiding taxes. So because money that goes into a Roth account is after tax money. So why would I make that deal? Well, on the backside, once you have money in a Roth account, it does grow tax deferred, but when you pull money out of a Roth account later in retirement, it's completely tax free. And having that tax-free bucket of money can really put you in charge of when and how much you pay on your taxes each year. So how do I get money into a Roth account? Couple of different ways. Now, Roth IRAs have been around for a long time. Roth IRAs are something you could most people typically fund them at tax time. But, there have always been a couple of issues with Roth IRAs. For one thing, the contribution limits are good, but they're not great. You can get up to $7,500 into a Roth account. If you're age 50 or older, you can get an extra $1,100 in, bring it up to $8,600 for this year. But the other problem with Roth accounts is that if you make too much money, you're not allowed to contribute to a Roth. So if you are a single filer and you make more than $153,000, you're going to get phased out of a Roth. If you are a married couple filing a joint return and you make more than $242,000, you're going to get phased out of being able to do a Roth IRA contribution. So is there a better way? I think there is, and that is a designated Roth account and a qualified retirement plan. So if you are still working and you have access to a 403B, a 401k, a 457B, all these different employer-sponsored retirement plans, they often will offer a designated Roth option. And in a designated Roth option, you can contribute up to your salary deferral amount into the Roth account. So for this year, that would be $24,500 that you could theoretically get into a Roth account. Now, when you do that, your contribution limit for a qualified plan is $24,500. So you don't get to do 24.5 into a Roth and 24.5 into a traditional, but you can't allocate it between the two however you want. So I'm not suggesting that everybody runs out and starts making all of their retirement plan contributions to a Roth account. You got to think about your current tax status, right? That's why I said before, it's important to know your tax bracket. So I'll give you a quick little example. Let's say that, my goal for this year is to get $10,000 into my 401k plan. And I have a choice between doing traditional or Roth. Now I could split that up however I wanted, but for the sake of our example, let's say I'm going to do either or. So first question I ask is, okay, what's my tax bracket? Let's say I'm in the 22% bracket. Well, if I contribute 10,000 to the traditional pre-tax 401k, I just saved $2,200 on my taxes. If I contribute that same $10,000 to the Roth account, it's going to cost me $2,200 in taxes because I have to pay that $2,200 and then the 10,000 goes into the Roth account, right? So which is better? It really depends on your situation. But here's one question I would ask you if you were going through that situation. And that is, let's say you contribute the 10,000 to the traditional pre-tax 401k, and you get that nice $2,200 tax break. Here's my question. What are you doing with that money? Are you setting it aside and saving it for retirement? Because if that's what you're doing, that's a pretty good strategy, right? Because now, let's say you open up a taxable account with Allison and you start funding that with your tax savings. Now you're going to have your traditional 401k and you're going to have a taxable account, right? That's a pretty good way to do it. But we all know that's not what most people do. Most people, when they get that $2,200 tax break, what do they do with that money? They spend it, right? It becomes part of their disposable income, and that's fine. We all do it. But what I would say is if that's what you're doing, if you're just spending that money and you're not saving it for retirement, that's when I would consider funding the Roth account. Because if you fund the Roth account, you're still spending that $2,200, but you're spending it on taxes. And by spending it on taxes now, what are you doing? You are buying Uncle Sam out of any future growth in that account. That is it. You have just locked in that $2,200 tax liability. No matter how big that Roth account gets, you only pay $2,200 in taxes on that money. That can be a pretty good opportunity. So there is another option, Roth conversions. In the interest of time today, I may be able to touch on Roth conversions in the Q&A, but that's what I wanted to focus on for now, was leveraging those accounts. Social Security. Couple of thoughts on Social Security. First of all, remember that Social Security is a very tax-efficient stream of retirement income. And one of the keys to a tax-efficient retirement can be maximizing Social Security. And the reason I say that is The longer you wait to claim Social Security, the bigger your monthly check is going to be. And what's cool is you don't have to pay federal income taxes on all of your Social Security. It has to do with how much other income you have. If you have a lot of other income, you will pay taxes on most of your Social Security. But here's the worst case scenario. Worst case scenario is you will pay taxes on no more than 85% of your annual Social Security benefit. So if I'm getting $10,000 of Social Security, I will pay taxes on no more than 8,500 of that. If I'm getting 20,000 in Social Security, I will pay taxes on no more than 17,000 of that. At least 15% of my Social Security is going to be federal income tax free. And if I don't have a lot of other income, I may pay taxes on less than 85% of my Social Security. This is the calculation you have to do to determine how much of your Social Security you pay taxes on. I'm not going to make us go through this, but just remember, worst case scenario, 85%. Here's another thing to keep in mind. Many states that impose a state income tax, including California, do not tax Social Security benefits. That's pretty cool. So having a good Social Security strategy can help you maximize your Social Security check, and that's a very tax efficient stream of retirement income. Okay, so let's try to wrap this up and bring this all together in a way that hopefully makes sense. So hopefully, as we are saving for retirement, what we're doing is we're thinking about tax diversification. We've got some taxable investments. We've got some tax deferred investments. And then hopefully we've also got that little tax-free bucket of money going. If we can do that, how do we leverage it? How do we use that to keep our taxes low in retirement? Well, here's a little example. So we're going to look at a little scenario here. We're going to look at two couples faced with the exact same situation. Both of our couples normally have total or gross income of $100,000 a year. But this year, each of our couples is going to have a couple of additional expenses. The first one is fun. They've got a great vacation plan. They're going to take their grandkids to the Grand Canyon. You can see they got the RV rented. They're ready to go. I don't know how you spend $10,000 at the Grand Canyon. I think they call that glamping, right? That's going to be the nicest RV you have ever seen. But that's what they got. They get 10,000 set aside for that. And they've got the other thing, not so much fun. They got to do $10,000 in home improvements. So let's see how our couples do when faced with these additional expenses. Now we're going to start on the left with couple number one. Couple number one, they have all of their money in tax deferred retirement accounts. That's actually pretty common. That is not like an unrealistic scenario. So when couple number one needs the extra 20,000, what are they going to do? They're going to tap their 401k. And that's an additional $20,000 of ordinary income. That brings their total income up to $120,000. Now the good news is they're going to get their full $35,500 standard deduction. They're going to get the full temporary senior deduction. That means their taxable income is going to be $72,500, but that completely fills up the 10% bracket. It almost completely fills up the 12% bracket. At the end of the day, their tax bill is going to be $8,204. Now let's look at couple number two. I always like to say couple number two must have sat in on this session because they've got a little tax diversification. They have a Roth account, they got a Roth IRA, and they also have some savings at the bank. Now, full disclosure, couple number two had to pay more in taxes, remember, in order to fund that Roth account. When you fund a Roth account, you are voluntarily agreeing to pay more in taxes now in order to fill up that tax-free bucket. But they have that Roth IRA. They also have some savings. So here's what couple number two is going to do because they have flexibility. For their vacation, they're going to tap their Roth account. I think this is a great way to use a Roth account. Roth accounts are perfect for some of those one-off, big-ticket, fun things you want to do in retirement, right? Because if you want to take that vacation to the Grand Canyon, that doesn't mean you want to pay more taxes for the year, right? So you tap the Roth, you take that $10,000 out, use it to pay for the vacation, does not add to your tax bill for the year. It's a great way to use a Roth account. Now, for the home improvements, they're going to tap their savings. And remember before when I said something as simple as a savings account can help you save money on taxes? You pull $10,000 out of the savings account, that doesn't add to your tax bill for the year. So they're able to keep their gross income at 100,000. And when they take their full deductions, that brings their taxable income down to 52,500. They've got $20,000 less exposed to the 12% bracket. That means they just saved $2,400 on their taxes for the year. Now, again, let's make sure, we're acknowledging the trade-offs here, because as I said before, couple number two voluntarily paid more in taxes while they were working in order to fund that Roth account. Why would they do that? Well, here's what I think. And I fund my Roth 401k at Nationwide pretty religiously. And the reason why I do it that way is I'm working now. I have income, right? I'm okay paying a little bit more in taxes while I have a steady income. When am I going to be most sensitive to paying taxes? When I'm an old retired guy. Because when I'm an old retired guy and I'm paying my taxes, where is that money coming from? It's coming out of my retirement accounts, and I'm not going to be too happy about that. So for me, that trade-off makes sense because I know myself. I know that when I'm retired, the last thing I'm going to want to be doing is writing big checks to the IRS. And having tax diversification gives me the flexibility to say, no thanks, I don't want to pay more in taxes this year. And by the way, as you look at this example, this is just the 12% bracket. If you have a lot of other income and you find yourself exposed to the 22 or the 24% bracket in retirement, that Roth money becomes even more valuable because that allows you to avoid even more in taxes. And remember, tax avoidance is legal. Tax evasion, you will go to jail. So just so we're clear about that. So hopefully what we've done here today is we got you thinking about tax diversification. What are some next steps? Allison and I were having a conversation before we got started today, and she was telling me about some fantastic tax planning software that she has available and what it can do. And that is a perfect next step. So if you really want to start being proactive about your retirement your retirement taxes, sit down with Allison and the team at Lumina and start looking at your overall financial picture and figure out, some next steps.
Awesome. And I would like to thank you again, Doug, for this presentation. Every single time you present, you bring us something new and something current. So I appreciate that so much. Have a wonderful rest of your Wednesday.
Thank you. Sorry
All
for being
right.
so
And we'll
long.
see you next time. Thank you so much.
Thank you.
Okay. Bye.